The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the September webinar titled Good Credit May Lead to More Savings, courtesy of MassMutual Financial Group. We appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today we will be taking a look at how your credit score can affect your ability to save. We will be providing an overview of how your credit score is calculated, how 20 to 30 points can make a difference, and what you can do to boost your credit score. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then, at the end of the presentation, we will take some time to go through these. With that said, I'd like to introduce our guest speaker, Paula Guerin, Retirement Education Specialist at MassMutual. Paula covers Missouri, Kansas, and Oklahoma for the Retirement Plans Group and specializes in 401k, 457, and 403b plans. I would like to thank Paula for joining us today, and with that said, Paula, I'll now turn it over to you.
Thank you, Christine. Good morning, everybody. As Christine said, my name is Paula Guerin. I am a mutual representative. We're going to go over, as she said, your credit score, and specifically, why is that important and why does it influence how much you can save? Most Americans don't fully understand their credit scores and how it works or how it's determined. But this number has become increasingly critical today with banks and lenders putting loan applicants literally under the microscope. These days of easy lending and borrowing are over, which is a good thing, but ultimately this means that consumers need to do everything they can to protect and perfect their credit reputation. Our reputation is largely reflected in our credit scores. We'll also talk about how you can boost your credit scores. What is a credit score? It's a number that reflects your credit worthiness. In other words, your ability to repay, and if you've ever had a time where you haven't paid. So it looks back on credit card balances, car loans, mortgages, student loans. The score is compiled by a company called FICO. FICO stands for Fair Isaac Corporation. It crunches and issues a number to your lenders. The score is based on information collected by three major credit reporting agencies, Experian, Equifax, and TransUnion. Each of these agencies issue a credit report, and FICO combines this information. Lenders typically look at all three scores. Briefly, there's also another generic score modeling called Vantage Score. The Vantage Score was created in 2006. It was created by the three major credit reporting companies and has a slightly different algorithm with more weight given to how much debt you're carrying. It's not as concerned about the age of your credit history. The other big difference is the range in scores. The FICO score typically ranges between 300 and 850, while the Vantage score ranges between 501 and 990. Anything above a 900 is considered excellent on the Vantage score, and anything generally above 750 is considered, or even 720 is considered very good on the FICO score. Your credit score does matter. For one, it determines your eligibility to attain more credit. 90% of the largest banks use your FICO score when determining your eligibility for loans and your interest rate that they'll offer you. If you're hoping to buy a home or a car or go back to school, you'll need a loan. A poor credit score may prohibit you from qualifying for a loan, and even if you do qualify, you might be subject to a higher interest rate, which means paying more for the same loan product than someone with a better score. As I said, a score above 720 or better is considered great. So maybe you're not in the market for a house or a new car, but having a credit score helps also with obtaining credit cards at more reasonable rates, lowering or qualifying you for better home and auto insurance, which means more savings, could help you land that apartment or even that new job, because most employers actually run a credit check before hiring you now. Your credit score is comprised of 5 basic areas. One, the payment history. That's the biggest chunk. That's 35% of your score calculation. It includes how well you pay your bills on time, whether you have any past due or bills in collection, and or whether you've had any bankruptcies in your history as well. The amount owed is equal to 30% of your credit score, and it's known as your debt-to-credit utilization ratio. Basically, it's the amount of debt you're carrying on all your credit cards versus the monetary limit on those credit cards. For example, if you're carrying a balance of $200 on one credit card and the limit on that card is $2,000, then your debt-to-credit utilization is 10%. The lower the amount owed, or the lower the debt-to-credit utilization, the higher your credit score. Excuse me. Your length of credit history is about 15% of your score and is equal to the time since your credit accounts have been open. New credit is equal to 10% of your credit score and reflects the number of credit cards and other loan accounts that you've opened, as well as credit inquiries placed on your credit or recently placed on your credit report. Types of credit used, that's 10% of your score, and it takes into account the different types of credit on file, such as mortgages, car loans, student loans, credit cards, and other credit cards like store credit cards. So all of the types are compiled into that type of credit used. Credit scores across the country, the national average is 692 according to Experian. That's one of the 3 major credit reporting agencies. The worst 5 states are Nevada, which is 668, Texas 670, Mississippi 672, Louisiana and South Carolina at 674. The best are Minnesota at 721, South and North Dakota at 719, Vermont at 716, and New Hampshire at 714. The point of learning all this is to ensure that you get to keep more of your money in your pocket. A healthy credit score means lower interest rates, and therefore, if you pay less in interest, you can save more for your retirement or sending your kids to college, buying a new home, or any other things you're trying to save for. A healthy credit score in action can be shown on these slides here. If you look at what they say is the tale of 2 home buyers, you'll see buyer 1 who has a credit score of 760. The mortgage amount they're taking out is $300,000. The mortgage term is 30 years. The interest rate they qualify for is 4.2%, which will give them monthly payments of $1,467. The total payments over the 30-year time period is $528,139. For buyer 2 with a credit score of 660, same mortgage amount, same details of the 30-year payoff time, but their interest rate of 4.8% is going to impact them, and their monthly payment will be $1,574, and the total payments owed would be $566,637. The big difference there, and that's the bottom line, is that the person with the lower credit score pays an additional $38,498 over that 30-year time period. If you took the monthly difference, that $107, over 30 years, and you put it into your retirement plan at an average 8% rate of return, it could yield you as much as $169,500. So you can see how your credit score plus the interest rate you pay can impact your savings over time. Another example you'll see is with 2 different credit card holders. When you apply for a credit card, you might see in the fine print that it will state the APR, which means annual percentage rate, at a range. It may say between 12 to 20% depending on your credit rating. If you have excellent credit, you'll qualify for the 12% rate. With poor credit, you might face the 20% APR. So let's see how that plays out on this screen. We see cardholder number 1 with a credit balance of $1,500, interest rate at 12%, minimum monthly payment of $30. The payoff time is about 9 years, and the total interest paid over that time period is $894. For credit card holder number 2, same credit balance, same $1,500 that they owe, but their interest rate that they qualified for was 20% or 8% more. The minimum payment, still at $30 a month, would take them about 19 years to pay off that debt. and their total interest paid is about $3,668. The total difference between those two people would be at least the $2,774. The math is for representing in rounded numbers so that the actual numbers could vary on these slides. But if we say that the look at $23 each month that you could be saving for 10 years instead of paying the loan off in, or the credit card off in 19 years, you paid it off in 9, and you saved maybe just $23 of that a month at 8% rate of return, that could yield you as much as $4,280. So I much rather save money than pay more to the credit card companies, and I think you would too. So what can we do to boost your credit score? Excuse me. We'll talk about some specific ways, and the more aggressive you are with taking on these ideas, the faster your score will improve. The big one is always pay on time, because if you don't pay your credit cards or other debts on time, it turns into what we call ugly debt. You know, we always have debt of various kinds. The only kind that is sometimes considered good debt is maybe a mortgage loan, because we're paying that to someday own something. But ugly debt is when it gets out of control. So if you pay on time, remember that comprises 35% of your total credit score. If you're forgetful at all, by the way, you should maybe automate your bills and pay those payments, whether it's to car loans, home loans, student loans, or credit cards, on auto draft or automatically, so that you don't fall behind ever. That should and will boost your credit score if you're always on time for those payments. And I have heard that sometimes your lender will reduce the percentage that you pay on interest rates a little bit, particularly with student loans. So whoever your lender is, ask them, if I set this on auto repay, will this possibly reduce the interest that I have to pay you? Also, don't carry high balances. If your goal is to keep your score well in the 700s, you don't want to be carrying too much debt month to month. Remember that debt to credit utilization. In fact, according to FICO, the top tier of borrowers who have a score above 760 have an average credit card utilization of just 7%. So to get on the right track, not only make sure you're paying every month, but try to pay off your bills every month in full, or at least pay more than the minimum. Because if you pay just the minimum, it's like being on a treadmill to nowhere. A treadmill. Think about a little hamster in his cage running on that wheel. He's really not going anywhere. And if you're always paying the minimum, it does take a lot longer to pay off your debt. For example, on an average $9,000 balance with a 15% interest rate, paying the minimum means you'll be done paying off the debt in 27 years. At the end, you've harmed your credit score and you've paid $20,000, which is more than double the original amount owed. But if you paid just an extra $50 a month, you could be out of debt in about 4 years and save $7,000 in interest. This might sound counterintuitive, but avoid closing credit card accounts, because the primary reason is that if you close a credit card, that credit limit on that card can no longer be used towards calculating your debt to credit utilization ratio, which could effectively raise your ratio and lower your credit score. So if you look at this example, you'll see that if you have 2 credit cards, credit card A has a $5,000 limit and you don't have a balance on it, so zero balance. Credit card B, you have a $10,000 limit and you have a $3,000 balance on that card. So if you take the total of the 2 limits, that's $15,000. So your debt to credit utilization ratio with both cards open is $3,000 of that $15,000 limit, or 20%. If you close credit card A, your debt to credit utilization jumps to $3,000 of $10,000, which is 30%. Remember, the higher the debt to credit utilization ratio, the lower your credit score. So closing cards can be negative as well. Also, don't open up too many credit cards at once. Each time you apply for a credit card, your lender places what's called a hard inquiry on your account. This goes for stored credit cards too. Multiple credit inquiries, 3 to 5, can lower your score by as much as 30 to 50 points, an impact that can last for 12 months. That said, if you're shopping for a car loan or a mortgage, it's normal that you will have a credit report score checked multiple times. And that doesn't hurt your credit score as long as the inquiries all happen within a 30-day period. The algorithm for your credit score is adjusted for these types of inquiries, and those are less worrisome than saying inquiries for opening up a lot of credit cards. So again, shopping for a car loan or a home mortgage isn't going to impact your credit score as much as opening a lot of credit cards themselves. Okay, how to check your credit score. Best way is to go to the source. There are many websites claiming that you can get a free credit score, and they might have some real catchy jingles. But most of those offers only provide you a free score if you sign up for a service, and that service may not be free. They might offer a trial period of something, and if you forget to cancel that trial period, then you get billed. So be very careful, read the fine print. If you want your actual FICO credit score, you can go to the source. Not free, it's about $20, but at myfico.com. You can also get it through the 3 major credit reporting agencies directly at Experian.com, TransUnion.com, and Equifax.com. You can get ballpark estimates for free at creditkarma.com, Quizzle.com, and credit.com. Also, if you are applying for credit, they have to evaluate your credit, and the lender might provide what's called a risk-based pricing notice, which discloses your credit score, and that should be free. So if you're on the phone with the lender while you're applying for the loan, you can ask them what your score is, and often they'll even tell you right over the phone. Stay connected with us on Facebook, Twitter, YouTube, or LinkedIn. Pensionmark is available to be contacted. They have bilingual licensed representatives available. Their number is 888-201-5488. They're here to help. I am, again, a MassMutual representative. The examples given were hypothetical and were included for illustrative purposes only and not intended to reflect actual performance. The information provided in this presentation was general in nature, has been obtained from various sources, is believed to be reliable but not guaranteed for accuracy or authenticity. MassMutual does not give legal or tax advice, and this does not constitute an offer to sell or solicit or an offer to buy any security, and does not purport to be a complete statement of all material facts relating to the retirement planning. Again, my name is Paula. I'd like to thank you very much for attending today's presentation. Soon, Christine will open the lines for questions. I should let you know that I'm not a credit counselor, a tax advisor, or an attorney. I have various experiences in the financial services industry. With that said, I'll be happy to answer as many questions as I can. Some of your questions may need to be forwarded for responses by others, though. It's been a pleasure to give this presentation today. Thank you so much. Christine?
Great. Thank you so much, Paula. That was all very, very helpful information. Please remember that if you have any questions, you can submit them using the Q&A tool on your webinar menu. And as always, for any plan-specific questions, you can always reach out to your dedicated service team here at Pensionmark. And as we wait for questions to filter in, I'd like to take a minute to let everyone know that, as Paula mentioned, you can stay up to date on the latest retirement plan news and events via Pensionmark's Facebook, Twitter, LinkedIn, and YouTube pages. And in addition, this webinar is recorded, and the replay will be posted on our website on the Investor Education Center, as well as our YouTube page within 10 business days. So with that said, we'll now move on to our first question. Paula, if someone finds mistakes or issues on their credit report, is there a way that they can address or correct these?
Yes. There is a process. Usually you have to contact those credit agencies directly and discuss with them what's in discrepancy, and then they will usually ask for some type of proof. I'm not familiar with every single step of the way, but I've known of people that have had to do that. They usually say they have a past overdue, and they'd have to maybe contact the credit card or the mortgage company that past overdue notice was from, and have them send a letter saying that it was a mistake on the report. It takes time, but it's worth doing.
Great. Thank you so much, Paula. The next question we have is, I understand that some debts cannot be collected after a certain amount of years. And is that so? And if so, can you explain a little bit more about that?
That's a great question. There are a few websites, and Chuck, I think you have one that's been provided that you can go to check on that. But it varies per state. Some states will say that certain types of debt after 3 to maybe 6 years cannot be collected on. But you have to check with your state and see how that is set up. The thing to remember is if someone's come after you for a debt, in many cases these are debts that you didn't know of, maybe another person in your name or had the same name and took out something, they're coming after you. If you do start paying on it by accident, I've heard that that starts that window up again. So say the state says, well, after 6 years they can't come after you, but then you make a few payments and realize that you shouldn't be paying for that debt, then that 6-year window starts again, and it can actually cause more trouble. So before you ever start paying on something that somebody comes after you on for an old debt, be careful about that. Hope that helps.
Great, thank you. Yes, definitely. That was a great question. The next question we have coming in is, how does co-signing a loan for someone else affect your credit?
To the best of my knowledge, co-signing a loan won't hurt your credit unless that person that you co-signed with doesn't make the payments. So if you co-signed, you're accepting the responsibility for that person. So say a child wants to take out a student loan and they're going to get a better rate if the parent co-signs. But then the parent believes that child has started paying off that loan on time. If they hadn't, then the parent actually becomes responsible, and you can be equally affected by that missed payment.
Great, thank you, Paula. Let's see here. Here's another question we have coming in. If you have or let credit cards go to collections, what is the best way to clean that up or address this?
That's a great question. Some of the sites that we've recommended through MassMutual are National Foundation for Credit Counseling, Money Management International, and the third option could be readyforzero.com. So if you can look into those sites, they can give you some really good credit counseling and help you to clean up your credit.
Great, thank you, Paula. And I think that is the last question that we have coming in. So Paula, I'd really like to thank you for taking the time to join us today. And that will conclude our question and answer period. If anyone has any additional questions, please feel free to reach out to your dedicated service team here at Pensionmark. I thank you all for joining us today. And Paula, once again, thank you so much for joining us and presenting today. And this now concludes the webinar. Thank you.
Thank you.